If you ever wondered how the tax system in the United States works, you're not alone. And this video is for you. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 15 years experience in corporate and public accounting. I have an extensive background in accounting, audit, and taxes. And I'm all about helping you take control of your money by living smarter. Be sure to subscribe to our YouTube channel and turn on all notifications. And check out our blog site where we post every Monday, Wednesday, and Friday. Today, I'm going to break it down in simple terms so you can finally understand what's happening with your money when it's being taxed. The first thing you need to understand about the US tax system is that it runs on a pay as you go system. So, what does the pay as you go system here in the US mean? That means that taxes aren't just due in April, they're collected throughout the year. If you're an employee, taxes are taken out of your paycheck automatically. Most people pay via withholdings from their paycheck. And if you're self employed, you just make quarterly estimated payments. So, if you don't pay enough during the year, you can face a balance due and possible penalties and interest. Now, let's talk about tax brackets. This is where a lot of confusion usually happens and comes in. The US uses a progressive system, meaning different portions of your income are taxed at different rates. Moving into a higher tax bracket does not mean all of your income is taxed higher, just a portion in that bracket. For example, the first chunk is taxed at 10%, the next chunk at 12%, and the next chunk is taxed at 22%. So if you move into a higher tax bracket, only the income in that bracket is taxed higher. Next, let's talk about taxable income. You don't pay taxes on everything you earn. You start with the gross income, then subtract deductions to arrive at taxable income. This is the number your taxes is based on. So, for example, it's a simple formula. We're going to take your total income, subtract out any adjustments, think of like retirement contributions and some other expenses, subtract out your deductions, whether you're taking the standard deduction or if you're taking your itemized deduction, and then we arrive to your taxable income. This is the number that determines your tax bracket and bill. All right, let's talk about tax deductions versus tax credits. Deductions reduce your income, while credits reduce your actual tax bill. Credits are a little bit more powerful because they directly lower what you owe. Let's talk a little bit about both in more detail. Deductions help to reduce your taxable income. They lower the income that gets taxed. For example, we have the standard deduction versus the itemized deduction. So, within that itemized deduction, think of things like the mortgage interest you paid, any charitable contributions, some qualified medical expenses. If you're in a 22% tax bracket, a $1,000 deduction could save you about $220. Now, let's talk about credits. Credits reduce your taxes directly. These are more powerful because they reduce your tax bill dollar for dollar. Think of some examples such as your child tax credit, education credits. $1,000 credit equals $1,000 less in taxes. Next up is a tax refund versus owing taxes. When you file your taxes, you're comparing what you already paid to what you owe. If you overpaid, you get a refund. If you underpaid, you owe. A refund is just simply meaning that you paid too much during the year. So the government is giving you that money back that you overpaid by. Owing means you didn't pay enough, so you have to pay the difference. This is an important note here. A refund isn't free money. It just means that you overpaid in the system throughout the year. Now, let's break down the four different types of taxes that you could expect to pay in the United States. In the United States, there's more than just income tax. There are payroll tax, sales tax, and property taxes. Each one funds different parts of government services. Let's take a look at each in a little more detail. First, let's look at income taxes. This is usually paid at the federal and state level. It's based on your earnings. You usually file it annually. Usually, it's due in April. Its federal taxes are handled by the IRS or Internal Revenue Services, and most states also have their own income tax agency. Usually it's your state's revenue department that handles it. Next, let's look at payroll taxes. These are just for those that are workers. These fund programs like Social Security and Medicare. It is split between an employee and an employer. So your employer pays a portion and you pay a portion. Social Security is 12.4% total and Medicare is 2.9% total. If you're self employed, you pay both sides of it. Now let's look at sales tax. Sales tax are paid when you buy goods or services. They're usually set by the state and local government. They're not charged everywhere, but they are for the most part common. So think of Delaware. Is a sales-free state tax. So you could buy a cheeseburger in Delaware from McDonald's for $1 versus buying it in Pennsylvania where it would be $1.06. And now let's look at property tax. Property tax is based on the value of the real estate. It's usually paid to the local government, which is usually either some kind of city, county, township, or municipality. It funds things usually like schools and infrastructure. Taxes aren't just a once a year thing, but planning ahead can help you save money. If this video helped you understand the tax system just a little bit more, hit the like button and subscribe and follow for more tax tips from a licensed CPA. And I'll see you next week where we break down more tax tips.